Two funds walk into the autopsy room chasing income from the same famous stock. One flashes a 12% yield and looks almost boring by high-yield ETF standards. The other waves a 38% yield like a neon sign outside a casino. But here's the twist. The bigger yield did not produce the bigger simple distribution-inclusive return in the data. That is why we're cutting these open today. AAPY from Kurv versus APLY from YieldMax. Same broad promise, turn Apple-related option trades into income. Same basic neighborhood, derivative income. Same temptation, monthly or weekly cash flow from a name everyday investors already know. But under the hood, these are not Apple stock with a dividend costume. They are option income machines. They use cash, Treasury collateral, government money market exposure, and call options to manufacture payouts around Apple's stock behavior. And when you compare the payout, the net asset value, the total result, the drawdown, and the distribution trend, you get a much cleaner picture than the headline yield gives you. Because in high-yield ETFs, the question is never just, how much did it pay me? The real question is, how much of the machine did it have to burn to make that payment? Today's matchup is AAPY, the Kurv Yield Premium Strategy Apple ETF, against APLY, the YieldMax Apple Option Income Strategy ETF. They are both trying to do a similar job, create current income and capped gains around Apple stock exposure by using a synthetic covered call strategy. That phrase sounds like Wall Street fog, so let's translate it. A normal covered call strategy is like owning a house and renting out the roof for billboard space. You still own the house, but you sell someone else the right to benefit if the property jumps above a certain level. You collect rent now, but you give away some future upside. These funds are not simply holding Apple shares and casually selling calls on the side. They are using options to create Apple-like exposure synthetically, while keeping the portfolio collateralized by cash and short-term fixed-income instruments. AAPY from Kurv was launched on October 27, 2023. It mostly holds United States Treasury bills at 95%, Fidelity Government Portfolio, ticker FIGS, at 3%, plus 3 call options, and 1 put option. The fund writes for premium income. It uses both standardized exchange-traded options and flex options. So the engine is Treasury-heavy collateral, option contracts tied to Apple behavior, and premium collection from writing options. The income comes from selling option rights, not from Apple sending a fat dividend check. APLY from YieldMax was launched on April 18, 2023. It mostly holds United States Treasury bills at 84%, First American Government Obligations Fund, ticker FGXXX, at 8%, plus 3 call options. The fund writes for premium income. It also uses standardized exchange-traded and flex options. Same broad concept. Keep collateral in safe, liquid instruments, then use options around Apple to create an income stream with capped upside. So the matchup is not Apple Fund versus Apple Fund in the simple sense. It is two different option income kitchens trying to cook with the same main ingredient. AAPY's current headline is more restrained. 12% distribution yield, monthly payments, 0.99% expense ratio, and $6 million in assets under management. APLY's current headline is louder. 38% distribution yield, weekly payments, 1% expense ratio, and $120 million in assets under management. That alone tells you a lot about the personalities. AAPY is the smaller, quieter machine. It pays monthly, has the lower stated yield, the slightly lower expense ratio, and far less asset scale. APLY is the bigger, louder machine. It pays weekly, advertises a much higher headline yield, has the slightly higher expense ratio, and much more money sitting in the product. But the important difference is not just the payment schedule. It is intensity. A higher option income yield usually means the fund is pulling harder on the option premium lever. That can make the cash flow look spectacular, especially in the short run. But the trade-off is that upside can be capped, downside can still hurt, and if the fund's NAV keeps shrinking, some of that income experience can feel less like harvesting fruit and more like selling pieces of the orchard. That is the core autopsy question for both funds. Are they turning Apple volatility into usable income while keeping the base reasonably intact? Or are they producing impressive-looking cash payments while the capital base does the slow-motion disappearing act? Before we go any further, this is research and education only. This is not financial advice, investment advice, tax advice, or legal advice. It is not a recommendation to buy, sell, or hold either fund. ETFs can lose value, including funds that pay high distributions. Option income ETFs can be especially tricky because the payout, the NAV path, the tax character, and the total return can tell very different stories. Always verify the current fund documents, including the prospectus, holdings, distribution notices, tax information, and performance data directly from the issuer or other reliable sources. And consult a qualified financial, tax, or legal professional who understands your situation before making decisions. We are here to understand the machines, not to hand anyone a buy button. Let's start with the shiny object, yield. AAPY shows a headline distribution yield of 12% and pays monthly. APLY shows a headline distribution yield of 38% and pays weekly. On the surface, that looks like an easy win for a PLY. It is showing more than triple AAPY's headline yield, and it pays more frequently. For an income-focused viewer, weekly cash flow can feel powerful. It lands more often. It feels more active. It scratches the same psychological itch as getting a tiny paycheck over and over again. But yield is where high-income ETF analysis gets dangerous if you stop at the poster number. A fund can show a huge yield because it is generating a lot of option premium. It can also show a huge yield because its NAV has fallen, making the payout look bigger compared with the shrunken base. And sometimes, both things are happening at once. So the better question is not just, which yield is higher? The better question is, how stable is the cash flow, and what happened to the fund while it was paying it? AAPY has paid $9.93 per share in cash distributions since launch. Its first 4 distribution average was 26 cents, and its latest 4 distribution average is also 26 cents. That is boring in the best possible way. Not safe, not guaranteed, not magical, but steady in this specific data snapshot. The recent average matches the early average. The monthly payment pattern did not collapse in the numbers we have here. APLY has paid more cash per share since launch, $13.96. That sounds better until you look at the trend. Its first 4 distribution average was 43 cents, while its latest 4 average is 7 cents. That is the key income autopsy cut. APLY has distributed more total cash per share, and it carries the higher headline yield. But its distribution trend shows a major drop from the early average to the latest average. That does not mean the fund is broken. It does mean the investor experience changed dramatically. The cash spigot that looked powerful early on is not flowing at the same average rate in the latest 4 data. AAPY, by contrast, paid less total cash per share, and the headline yield is lower, but the first 4 and latest 4 averages are the same in the data. So if you are comparing yield quality, not just yield size, the contrast is sharp. APLY is the fireworks show. Higher headline yield, weekly pay, more cash distributed per share, but a distribution average that fell hard. AAPY is the smaller engine. Lower headline yield, monthly pay, less cash distributed per share, but a much steadier distribution average across the first 4 and latest 4 snapshots. And that is why headline yield can be a trapdoor. A 38% number can grab your eyeballs, but the distribution trend tells you whether the machine is still throwing the same kind of sparks or whether the flame has cooled. Now let's move from the cash coming out to the capital base underneath it. This is where the net asset value story matters. AAPY had a launch reference price of $25.24. Its latest NAV is $23.95. Its NAV return since inception is negative 5%. That is not a victory parade, but it is a relatively modest decline compared with what we see on the other side of the table. APLY had a launch reference price of $20.28. Its latest NAV is $11.32. Its NAV return since inception is negative 44%. That is a very different journey. If AAPY's NAV path is a dented fender, APLY's NAV path is a vehicle that came back from the road trip missing a door. And this matters because the NAV is the base that supports future earning power. In an option income fund, the capital base is not just a scoreboard. It is part of the engine room. If the base shrinks, the fund may have less capital to support future option positioning, and the per-share payout can become harder to maintain at earlier levels. That does not mean every NAV decline is automatically fatal. These funds are designed to pay out income, and some decline can be part of the trade-off. If a fund is distributing a lot of cash, you expect the NAV chart to look different from a pure growth stock chart. But the size of the decline still matters. AAPY's latest NAV is below its launch reference price, but the drop is contained in this data. APLY's latest NAV is far below its launch reference price, and the NAV return since inception is much deeper. This also helps explain why a headline yield can look so large. If the NAV falls substantially, any distribution can look bigger as a percentage of that lower base. The yield number can get louder even while the account value experience gets more complicated. So on NAV preservation, AAPY clearly held up better in the data. APLY paid out aggressively, but its NAV path shows much more erosion. That is the trade-off in plain English. APLY gave you a much bigger income headline, but the floor under the machine sank much further. AAPY gave you a smaller income headline, but the platform it stood on stayed closer to where it started. Now we put the two halves together, distributions plus the NAV path, because looking at yield without NAV is like judging a restaurant only by the dessert cart. Fun, but incomplete. AAPY's cash distributions since launch were $9.93 per share. Its NAV return since inception was negative 5%. Its simple distribution inclusive return was 34%. APLY's cash distributions since launch were $13.96 per share. Its NAV return since inception was negative 44%. Its simple distribution inclusive return was 25%. This is the main plot twist of the comparison. APLY distributed more cash per share. It shows the higher headline yield. It pays weekly. It has more assets under management. It is the louder product in almost every income marketing sense. But AAPY has the higher simple distribution inclusive return in the data, 34% versus 25%. Why? Because the cash that came out of APLY had to fight against a much larger NAV decline. This is the difference between receiving a big stack of checks while the principal balance shrinks hard versus receiving a smaller stream of checks while the principal balance holds up better. Both funds paid. Both funds delivered income. Neither is a plain Apple holding. Neither gives uncapped upside to Apple's full rally potential because the option strategy trades away some upside in exchange for premium. But AAPY's total picture was cleaner in this data. Less dramatic yield, less dramatic payout frequency, less cash distributed per share, but also much less NAV damage, leading to the better simple distribution inclusive result. APLY's total picture is more conflicted. It paid a lot of cash, but it gave up a lot of NAV. That can still appeal to some investors who care intensely about cash flow timing and are comfortable watching the base fluctuate or decline. But the all-in result shows why highest yield wins is not a serious investment framework. A fund can pay you a lot and still trail another fund that pays less if the lower-paying fund protects the capital base better. That is the educational takeaway here. The payout is only one side of the scale. The NAV path is the other. Total return is where the scale finally stops wobbling. Now let's talk risk, because option income funds can look gentle when they are mailing distributions and suddenly feel very sharp when the market moves against them. AAPY's max drawdown was negative 35%. APLY's max drawdown was negative 51%. Both numbers matter. A negative 35% drawdown is not mild. That is not a sleepy cash substitute. That is a real decline. AAPY may be the steadier of the two in this comparison, but it still had a serious drawdown. APLY's negative 51% max drawdown is more severe. That is the kind of decline that tests whether an investor actually understood the product or was just hypnotized by the income percentage. And this is where the mechanics matter. These funds generate income through option premium, but the premium is not a force field. Selling calls can help generate cash, but it can also cap upside when the underlying exposure runs. The synthetic structure can create Apple-linked exposure without simply owning the stock outright, but that does not remove market risk. If the strategy suffers, the NAV can fall. If the NAV falls far enough, the fund may need to reset its future distributions lower because the base supporting those trades has changed. That is why the distribution trend belongs in the risk discussion too. AAPY's first 4 distribution average was 26 cents, and its latest 4 average was 26 cents. In this data, the payout average was stable across those snapshots. APLY's first 4 distribution average was 43 cents, and its latest 4 average was 7 cents. That is not just an income story. It is a risk story. It shows the cash flow experience changed materially over time. So the risk profiles are not identical. AAPY's risk is that you still have a derivative income fund tied to Apple-related option exposure, with capped upside, real drawdown potential, and a NAV that is below its launch reference price. The steadier distribution average does not make it low risk. It just means the income stream in this data did not show the same drop-off. APLY's risk is more aggressive. The headline yield is higher, the payments are more frequent, and the assets under management are much larger, but the fund also shows the deeper NAV decline, deeper max drawdown, and sharper fall in distribution average. That combination matters because it can create a painful investor psychology loop. At first, the weekly cash flow feels like validation. Then the NAV falls. Then the distribution average falls. Then the investor has to ask whether the original income goal still works with the new base. That does not make APLY bad. It makes it specialized, intense, and potentially unforgiving if someone bought it expecting a high-yield savings account wearing an ETF jacket. AAPY looks less intense, but still belongs in the same caution zone. It is not Apple stock. It is not a Treasury fund. It is not a guaranteed income contract. It is a strategy that sells option exposure around a famous underlying and accepts trade-offs to create distributions. So on risk, the cleaner profile in this data is AAPY. But cleaner does not mean clean. It just means the drawdown, NAV erosion, and distribution trend were less severe than APLY's. So what is the verdict? AAPY and APLY are different tools built for investors who want Apple-linked option income, but they are tuned very differently. AAPY is the more restrained tool in this comparison. Lower headline yield, monthly pay, smaller asset base, slightly lower expense ratio, less cash distributed per share. But it held up better on NAV, had the higher simple distribution inclusive return, had the smaller max drawdown, and showed a steadier distribution average in the data. APLY is the more aggressive income tool, higher headline yield, weekly pay, larger asset base, slightly higher expense ratio, more cash distributed per share. But it also had much deeper NAV erosion, the lower simple distribution inclusive return, the larger max drawdown, and a distribution average that fell sharply from the early snapshot to the latest snapshot. If the goal is maximum visible cash flow and frequent payments, APLY is the louder machine. But the data shows that loud came with a cost. If the goal is a more balanced version of Apple-related option income, AAPY looked more durable in this specific comparison. But it still had a negative NAV return since inception and a real drawdown, so nobody should confuse it with a conservative income parking lot. The cleanest way to think about this matchup is not, which one should I buy? It is, what job would this tool be doing in a portfolio, and what am I willing to give up for the payout? APLY is the high-output machine that may appeal to someone studying aggressive cash flow products and fully aware that the base can shrink hard. AAPY is the more measured machine that may appeal to someone studying the same Apple-linked income concept, but with less extreme erosion in the data. Neither fund is a free lunch. Both are taking Apple-related volatility, wrapping it in an options strategy, collecting premium, paying distributions, and accepting capped upside and real downside. That is the autopsy. The headline yield tells you who shouts louder. The NAV tells you who bled more. The total return tells you what was left after the shouting stopped. And as always, this is research and education only, not a recommendation to buy, sell, or hold either fund. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.